Hi, everyone. As you're filing in today, I want to welcome you. My name is Marche. I'm the webinar director here at Advice Chaser. And before we get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this webinar today. Hopefully this will clarify maybe some questions you might have if you are anticipating a layoff or getting laid off and you're not quite ready to retire yet. Uh, just a couple of other housekeeping notes. Attendees are muted, but we do encourage you to ask questions using the chat box. And if we don't have a chance to address your question, go ahead and leave your phone number, your email address as well, and we will make sure someone reaches out to you after today's event to make sure that question gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Blaine Thierman is the founder and lead advisor of Progress Wealth Management. As a certified financial planner, it is his life's mission to provide unbiased financial education, advice, and guidance to help his clients create their path to financial independence. Blaine believes that true comprehensive financial planning can provide the clarity and confidence necessary for families to understand and implement their own well-informed decisions. Blaine's goal is to translate the complexity of financial topics into a simple step-by-step action plan to help his clients understand how to align their money with their personal values and objectives. As a trusted source, Blaine's insights have been featured in articles by Forbes, GoBankingRates.com, The Washington Post, Yahoo Finance, MarketWatch, Business Insider, and MSN. And Blaine, we're excited to have you here on Advice Chasers webinar series. And I'm going to go ahead and turn the time over to you.
Well, I really appreciate that introduction, and I'm excited to be here. I think this topic is one that a lot of us have either experienced in the last couple of years because COVID's caused more layoffs than basically any other event in our lives. And I also think this is an important one because a lot of people don't know what to do and who to go to when they're looking for advice on this kind of transition in life that's so unexpected and can be so terrible. So I'm excited to help people figure out, well, how to think about this if this is a risk or if this is your reality. So some reasons some companies do lay off their employees. So number one, needless to say, if you're a 30 or 40-year veteran of your industry, you probably are making more than most people are that are in your role. And as a result, you cost the company a lot of money during tough times, and they're trying to cut costs. Obviously, if the most expensive cost they have is labor. So that's typically one main reason why they look at some of these veterans in their professions. And they try to say, well, who should we cut first? Possibly you. The next reason is they assume you're going to retire soon anyways. They assume that you've saved well without actually verifying it. They assumed that you're financially prepared to retire, so why not? Let's just give you the forced opportunity. Another reason is sometimes, as we all notice, even if you are a veteran, you don't always do things that require a veteran level of ability. Sometimes there's going to be a simpler day, and they believe maybe they can hire someone else to do the job that you're doing at a lower rate. Maybe they're right, maybe they're wrong. More often than not, they're wrong, but sometimes they can't be convinced otherwise. And lastly, I've worked with a lot of software engineers throughout my career, and a lot of them, they say that when they get into their 60s, they don't want to, in their free time, sit around and study new technologies. They'd rather be doing other things. So it gets harder to stay up to date with changes and updates in your industry. And this isn't just to software engineering. It also could be other kinds of technical roles out there, or changes and updates in your industry and how you do your job. They get more and more difficult the older we all get, with a lot of us. So Now, some questions to ask yourself. Number one, are you actually ready to retire? If you believe that there's a chance that you could be laid off, you have to really realistically prepare for this forced transition in life. And how do we prepare? We figure out if you can afford it. Can you afford to retire right now? And if you can't, and you are forced to anyways, what adjustments would you have to make in your lifestyle, the way you spend, where you live, how you live, some of your goals? These kind of things would have to really confront and ask ourselves, what sacrifices would I have to make if I was forced into retirement right now? Now, next big question is to ask, if you were fired, would that be legal? Because needless to say, if they look at people that are only the oldest and they say, let's fire the oldest, that's against the law. That's inappropriate. It's not legal and it's not kind. And for that reason, it makes sense to contact an attorney in some scenarios. See if you actually have a case. Because if you're not prepared to retire and they force you to retire anyways, you have a hard time finding a job. Not only would that be good to protect the rights of people that are more seniors in their professions, but it'd also be good to make sure that you set a standard for what is and is not permissible in the United States. Another big question is do you actually still want to work full time anyways? Because when you go through this transition, the next big question is what are you going to do after you're forced into retirement? Are you going to work full time? Are you going to work part time? Are you going to work a contract job where you work 6 months and then you have 6 months off? All these questions are something that's important to ask yourself as you make this transition. Another really important one that can really change everything, especially if you have any health conditions that are expensive, is what kind of health insurance needs do you have? Because how are you going to insure yourself from whenever you get laid off until you get on Medicare 65? That can get incredibly expensive. And private health insurance providers, if you have one claim, any pre-existing conditions, they can drop you. They're not required to keep you on for by insurance law at all. They can drop you whenever they want. So if they think that you're going to cost them more than you're going to pay them, they have no reason to keep you. And lastly, you have to ask yourself, what are your options? Now, the next few slides, I'm going to be going over what your options really are to help pay your bills, to help make sure that your life is as stable as we can make it. But needless to say, it's likely you'll have to make a couple pivots in life. Now, the first option that I would say is the most common one, given the amount of skill, talent, effort, education, designations, so on and so forth that you've gained throughout your career, small businesses can definitely benefit from hiring you on. And needless to say, they might not be able to afford you long term, but they might want to hire you on for a short term project. Some places you can find work like this. One of them is a website called Upwork.com. Upwork, you can create a profile. You can put your skills, your talents, your resume, your background, and you can end up offering your employment to small businesses. And there are people that are on Upwork that literally make over $100,000 a month. So it's completely feasible that you could have a good living on there. Needless to say, that's the exception, not the rule, but it's possible. Now, this is especially good for entrepreneurial minded because you don't have stable income. It's not going to be guaranteed. It'll be possible. Another good website to go to is a website called Fiverr.com, Fiverr.com. You can create a profile. You can offer yourself to do work on there to small businesses. And again, your experience, your talents, these all can be really helpful to help you make sure you actually get income. Now, some downsides of this: you're not going to have health insurance, number one. Number two, you're going to pay self-employment taxes twice. So you've probably seen on your pay stubs in the past, FICA FUTA, it's about 7.5% of your income. Well, you're going to have to pay that twice as a self-employed person. That hurts. But if you're still making a higher hourly, that's not a bad deal. Now, I did get a question real quick about health insurance, I believe. Um, now, you can, so the Affordable Care Act. So you asked, so Jeff Dill, he asked, I don't think they can drop you because you have claims any longer, insurance. So it's regarding to health insurance. If you are on the Affordable Care Act, they are not permitted to drop you. The Affordable Care Act, AKA Obamacare, you can get on that and they're not able to drop you. But in exchange, you typically pay a higher premium, have more out of pocket. We'll talk more about that down the road. But if you go through a private health insurance provider, you go contact Anthem, you go contact Banner Health, so on and so forth, you can purchase private health insurance not through the Affordable Care Act. And it's typically going to end up being a bit less expensive, but they can drop you. And that's how they make it less expensive. They drop the people that use it the most. Okay. So please feel free to put another question in there if you have any other clarifying or if you need any additional detail. Now, the next big opportunity is working part-time as a consultant. A lot of companies these days hire consultants. So PricewaterhouseCoopers, for example, I was consulting there for a bit as I started my own practice, Progress Wolf. And it's a great way to earn an extra high hourly for experienced hires. Now, that's the big upside. Oftentimes as well, they provide health insurance too. The big downside is they can drop you at any moment, just like you're a contract employee. Just like you are someone who is mowing your lawn. You can say, hey, guy, mowing my lawn, you're fired anytime you want without worrying about HR law, without worrying about anything. It's the same thing with consultants. Now, also as well, you don't get a lot of the same respect, the same culture, the same benefits. Typically, the benefits are much more expensive, but you do have benefits. That's the big upside. And so this is why this is oftentimes a really well-used resource to help pay your bills as you're going through this transition to Medicare or into retirement. That's the reason why a lot of people like this. Now, these assignments can be temporary. Typically, they'll tell you this is a 12 or 6-month long contract, and they give you sometimes the opportunity to extend it, but they don't guarantee it'll be extended. They can change their minds at any moment, which doesn't give you a lot of stability. This is also why sometimes people don't like these kind of opportunities. It's nice to have stability. When ageism, it feels alive and well in the United States, unfortunately. Now, the next big option is some people say, Blaine, I got laid off, and you know what? I want to just retire. How can I retire? And needless to say, an extra 5 or 6 or 7 or 8 or 10 years of retirement, it sounds great for a lot of people, but it's also really difficult to afford. That's the hard part. So how do we make it more affordable? Well, you can retire and you can downsize. So I've had some clients in the past move out of country to a place that's far less expensive. Thailand, Portugal, so on and so forth. And by decreasing your cost of living, by owning your home outright, by having lower healthcare costs, by moving to a lower, less expensive area, um, and by maybe cutting some of the things that you planned on doing that were fun but expensive out of your retirement plan, it can make retirement actually a lot more affordable for a lot of people. Just think about it this way. If you still get Social Security and you live in a place that's 1/3 the cost of living as where you live right now. Let's say you live in San Francisco, right? So 1/3 the cost of living. Maybe you're moving to West Virginia. Maybe you're moving to Thailand. Social Security would basically pay almost all your bills as soon as it turns on, and you only need enough money to get you to Social Security. That could make a huge difference in places like Portugal. They have free healthcare. Now, you might not want to move out of country because family is close by. Maybe you want to be close to your grandchildren. That's fine. I don't blame you. I don't think anybody out there says, geez, I dream of a retirement where I don't have my grandkids in it. But if you can't afford to, you can't afford to. And if you don't expect to have a long retirement because of health conditions or your family doesn't typically live past a certain age, sometimes it makes sense to move to a lower cost area anyways, just travel and see them more often. It depends on your circumstances. Now, what about health insurance? So typically the first thing I would look at for someone who is laid off and they retired earlier than they planned is to get on your spouse's insurance. If your spouse is still working and they have health insurance available, this is easily the least expensive and best option available. You'll have the highest quality insurance and it'll cost you the lowest amount because your spouse's employer is helping to pay for your health insurance. Makes a lot of sense. Uh, Now, needless to say, it's important to evaluate what options are available. Can you still go to the same doctor? What will be the coverage for your medication? What will be the out of pocket? And what plans are available? Do you need a lower deductible plan? Or are you two in good health and can you get on a high deductible? Get access to an HSA? All these questions are worth asking when you decide to get on your spouse's insurance so you know what to expect. The next big option is called a health sharing plan. Technically, this is not health insurance. This is sort of a group of people, typically through a religious institution, will agree to share the healthcare costs with one another. And normally there's a deductible, normally there's co-insurance, just like normal health insurance. But the big downsides are they normally will not cover pre-existing conditions. So if you're a cancer survivor, if you have any diabetes, if you've got a thyroid issue, so on and so forth, you're a heart attack survivor, they will not cover any pre-existing conditions that you have prior to getting on their plan. And also as well, there are some better health sharing plans than others. Occasionally, because these are not as big and as stable as big health insurance providers, they can drop you just like a private health insurance provider will. And then the next big option is the Affordable Care Act. Now, if any of you are thinking you might want to get on the Affordable Care Act, which is the health insurance I was referring to earlier that they're not able to drop you from, I'd recommend you go to healthcare.gov/C dash plans and put in your information. Reason being is this will get you quotes on what it would cost for you and what options are available in your zip code. Because the Affordable Care Act, it differs by zip code. So I can't tell you exactly what it would cost you. Okay. Typically, the very lowest I've seen is $800 a month. The very highest I've seen is $3,600 a month. So it's not cheap. It's not affordable for most people, despite the name. But there is something, though, that you can get to make this more affordable. If your income is low enough, you can get a subsidy. Now, when we say low enough, it has to be very low. So if you don't think you can get it very low because you've saved well throughout your life and you expect to make a lot of money as a contractor or as a consultant, needless to say, you probably won't get a subsidy. But what you could do, though, is if you have a large Roth, if you have a Roth 401k, if you have lots of money in your bank account or in a brokerage account, these are all kinds of things you can pull from to pay your bills and pay less taxes on as you take a distribution. And you can, as a result of that, manipulate how much income you have in the IRS's eyes. I'd recommend you talk to a CPA about that if that's an option you want to look into. But it's definitely not a bad option, and I've helped a lot of clients with it in the past. So if, as a result of this subsidy, you can get that monthly premium down as low as $1 a month in some states. It makes it much more affordable. The last option is a part-time job with a company that provides health insurance. You'd be surprised how many multimillionaires work at Home Depot working part-time. It's a very relaxing job, and they give health insurance that's only $40 a month to their employees. Same thing with Starbucks, same thing with Lowe's, same thing with a lot of these big box retailers that are looking for part-time workers. You won't make next to nothing, but at least you have health insurance. And if it's not affordable for you to pay $3,600 a month for the Affordable Care Act for halfway decent deductible, this is an option worth thinking about. All right. Now, some other considerations. Now, retirement accounts, you can withdraw from these without penalty at 59.5. So pre-tax accounts, you'll still pay taxes on every dollar that you take out of them as if you earned it. Roths, you won't pay taxes on a single penny that comes out of a Roth. So that makes things a lot easier. Employer sponsored accounts like 401ks, there's a rule called the rule of 55. If you retire at 55 or later, then you can take money out of 401ks, 403bs, these employer sponsored retirement accounts without penalty at all. So most people think 59.5 is how long you have to wait. That's not true. If you roll your IRAs into your 401k, any rollover IRAs you have at least, all of a sudden you can take money out of that 401k penalty free as well. Right? Perfectly fine. Now, needless to say, everyone's circumstances are different. So I'm explaining a lot of rules of thumb here today on how to think about things, but this is not advice. And everyone's circumstances are so different, in fact, that it deserves a lot of individual focus on your tax plan. Now, a financial advisor can help you figure out your retirement spending strategy so you don't run out of money. Before you hire on any, ask them, do you actually help with every single year figuring out the most tax efficient way to take money out of my accounts? Ask them what kind of software they use to actually do this, because if they're telling you they're going to do it freehand, they'll probably do it poorly. Alternatively, you can also work with a CPA or an enrolled agent as well. Both of those are tax professionals. Now, a couple things that are important to think about as you have low income is number one, of course, your tax bracket's going to be lower. which gives you a lot of opportunities. And the biggest opportunity that I typically look at is a Roth conversion. Roth conversions are where you take money that's in pre-tax accounts and you fill out a form that's called a Roth conversion request. And you convert money from IRAs to Roths. And you pay tax on the full dollar amount of that conversion in the year that you do it. And what does that mean to you? Well, the whole dollar amount that you decided to convert that year is going to grow tax free for the rest of your life. That makes things a bit easier for you to pay for when you're in your 80s and 90s. Now, the trick is you're not going to convert the whole account all at once. Typically, you'll do this artistically. You'll say, well, how much income do I have and what tax bracket do I want to stay in? Let's say if your tax bracket, you want to stay in the 12% tax bracket, hypothetically. Top of the 12, when you're married, filing jointly, is about $84,000 this year, roughly. And let's say your income's only 60 grand. Well, you'd say, what's the difference between 60 and 84? It's 24,000. That's how much you'd convert from IRA to Roth. And as a result, you'd only pay 12% taxes. That's a good deal. I'm okay paying 12. Most people are. Now, this is something that most people do literally every year they're retired, so they have a tax efficient retirement strategy. Now, you might not want to stay in the 12. Maybe that's not possible for you. Maybe it's the 24 you want to stay in. Maybe it's even higher than that. It just depends on your circumstances. But this is really important. Otherwise, you'll be wasting money on taxes when the government starts requiring you to take money out of these pre-tax accounts down the road. Now, another really important one to think about is the opportunity to sell any real estate you own. Now, capital gains, long-term capital gains starts at a 0% rate. Then it jumps to 15, and it jumps to 20. And when you're in a low income year, you can actually have a large chunk of that capital gain at 0% or 15%. Both of those are probably lower than what you pay taxes at on the income that you earn. So it's important to consider this in any low income years you have, and this might be a reason to talk to an advisor or a CPA. And lastly, let's say, for example, you make 50 grand per year working part-time as a consultant. And you say, Blaine, I think I'm going to make a lot more than that. I've made a lot more than that throughout my whole career. I've always been at a higher tax rate than I'm paying right now. You've got all this money in a pre-tax account. Maybe you only have an extra 50 or 60,000 left on your mortgage. Why not pay it off? Take the money out of the pre-tax account, pay taxes at a lower rate, and pay off your mortgage so you have lower bills in retirement. Makes retirement a bit more fun if you have less bills. You don't worry as much about money. Also, makes it so you don't depend on the stock market performing as well over the next 30 or 40 years, which it might, but it also might not. Hard to say for sure. And we know for sure if you pay off your mortgage, you'll have lower bills. It's a lower risk strategy. Okay.
All right. We're
So
gonna, oh, go ahead. Sorry, Blaine.
Gone over a lot today, and I apologize if anybody's eyes glazed over a little bit. Some of this stuff gets a little complicated, but long story short, you've got options, and all is not lost just because you were laid off. You've got options to consider. Now, down the road as well, if anybody is looking for any free consultations or any free advice on this kind of thing, I'm happy to do so. I've had a lot of clients in the past go through this kind of transition in life, and it gets stressful and it feels awful. And I promise once you've figured out your plan, things won't be as awful as they feel or may seem. All right. So I appreciate your time today, Marche. I really appreciate the opportunity to be in this and help all these people. Hopefully
Yeah,
none of them are going through this.
we have a couple questions, and then
Sure.
we'll be able to end after the few questions I have that have come in. Here's a good one. Just if you work as a consultant, are you an employee or are you an independent contractor?
Depends on the company. Some companies will bring you on as a 1099 employee. So you're a 1099 contractor. A couple companies out there will have you be W-2, but the large majority will be 1099.
Okay, and so I guess a follow-up question to that would be, which is the one where you have to pay self-employment tax?
1099.
Okay. Have you seen other people take the opportunity of a layoff to switch into a totally different field?
Absolutely. Yeah, I've seen a lot of people that decided to go teach as college professors. after a lot of experience. Normally, that experience they have transitioning to being a professor actually is welcomed. I've heard some people as well decide to start small businesses. Some people have dreamt about it their whole lives. And they say, I've got the opportunity. Maybe we'll start getting rental properties and get my real estate agent's license, make all these rental properties my own business. It just depends on what you're interested in, but it's
Mhm.
absolutely something people will look into.
Here's a good question. What about taking out a loan or a home equity line of credit, especially when you're in that transition phase?
Um, well, that's a very high risk strategy because, needless to say, home equity lines of credit, they have a monthly payment and you pay interest. If it's your last and only option, it might be worth considering, but I'd definitely try to explore every other option before taking on a lot of debt so that you can end up paying your bills.
And someone else, what about a reverse mortgage?
Reverse mortgages are basically like an annuity that's collateralized. Your home, it secures the loan the company's giving you, and the loan they're giving you is that monthly income. So, big upside of reverse mortgages, they're non-taxable because they're a loan legally. So no taxes on that. And if you're getting Social Security, no taxes on Social Security either, if that's all your income. Big downside is that eventually you could lose your home. And if you don't lose your home before the end of your life, you leave your family a terrible mess. And all the while as well, there's a lot of fees and interest that you pay and problems and all sorts of things. So for that reason, a lot of people dislike reverse mortgages except for in their very last resort. It's the last resort of any financial plan for a retiree.
All right. And so there is a comment here with the job market being so good for employees right now, it might be easier to find a new job, even if you're an older worker.
Absolutely. I recently another client of mine. He's 62. He worked at an architecture firm for over 30 years, and they laid him off during COVID. We found him a new job. He's already made it to partner, and they didn't push him to partner for the last company, so it ended up being actually a better thing for him, in the long run of things. So just because you got laid off doesn't mean you can't find a job. Doesn't mean you can't find a better job even. So ageism, well alive and well, it's not as alive and well as we all think it might be. Good things can still happen.
Excellent. Well, thank you so much for being with us here today. I want to thank Blaine for being here. I want to thank our attendees for being here. Look to your email for a link to the replay of this event, and you're welcome to share that with friends and family. And we wish you all the best with your future endeavors. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Goodbye, everyone. I appreciate it. Thank you.